Good evening, ladies and gentlemen. Thank you for joining us at FSM ETFestival 2020. We're really looking forward to everything that we have to share with you. Over the next 4 days, we'll be having our in-house research team that's behind many of the articles at fsm1.com, as well as ETF issuers, Nikko Asset Management and Samsung Asset Management, to share with you their latest on incorporating ETFs into your portfolio and the pertinent trends that can help you invest globally and profitably. For tonight, our theme is easy to familiarize. We'll get you up to speed about ETFs, investing strategy, and using the tools we have available on our platform to get down to investing in ETFs. In this opening session of ETFestival, we will hear from FSM1.com's General Manager, Mr. Jean-Paul Wong, about the important perspectives and understandings that investors need to have as they embark on their investment journey. With insights gleaned from over 20 years of serving investors in Singapore and more recently in the region, we will share with you the common pitfalls to avoid and the best practices to adopt. So please help me to welcome Mr. Jean-Paul Wong.
Hi, thanks Jonathan for the introduction, and a warm welcome to all of you, our dear investors. I hope that you're keeping yourself safe during these times, and I'm very happy to welcome you to our ETFestival 2020 on behalf of the FSM1 team. So to kick off things tonight, the topic that I have here is deciding how to invest, investing concepts to understand before getting started. So we held our first FSM ETFestival in 2019. It was the first time there was an ETF-focused event in Singapore, and we were happy to be the first one to have such an event for investors. And since then, we have been working to improve your investment journey, and these are some of the milestones that we have achieved. So late last year, we launched the FSM ETF Regular Savings Plan. So for investors like yourself, you can start a regular savings plan from $50 into various ETFs that we carry on FSM1. And this year, our research team has updated the ETF focus list, and it has new members, new entrants into the focus list, and I'll be talking a little bit more about it later, as well as my colleagues from the research team and from the investment advisory team. And very recently, in the month of July, we've added new payment method for CPF and SRS payment methods for SGX listed stocks and ETFs. And of course, this month in August, we're holding the ETFestival for the second time. And we really hope that tonight, as well as the next few days, all the way to Saturday, we'll be able to do our part to help you have these investment ideas to build a globally diversified portfolio together with our partners as well, from Nikko Asset Management as well as Samsung Asset Management. So I'll run through three main sections today. So I'll start with the first part, just a quick recap of how the markets have been performing. So broadly divided between the global equity markets on the one hand, and then the global fixed income markets on the other hand. So it's been a really topsy-turvy year this year for us. So we started off the year in a fairly, bullish mood, only to have a huge, correction and downturn in the markets in the month of March. And that also then kind of like ended very quickly, and we saw a huge recovery in various markets since that low point in the month of March. And if you look at equity markets, for example, on this chart, you'll find that there is one sector that has been outperforming, and that's the digital economy. And I guess many of you are familiar as to why perhaps this sector has been, doing so well, especially, in times, in these disruptive times brought about by COVID-19. So you have a lot of these technology companies which have a very digital business model that have been able to continue to do well, and in fact even improve their businesses in the last few months. So we'll talk a bit about this later on as well. And of course, some of the other markets have done well, like China onshore market has done quite well as well, if you look at the equity markets chart. For fixed income as well, they were not spared by the downfall, the downturn in March. So some of them really had a huge, negative downturn in the month of March. But most of the fixed income segments as well if you compare to the start of this year, right, they are basically back to slightly positive territory. So this point, the first part, remember the why. It's something that we like to share with our investors, because when you start investing, we like to just remind ourselves the reasons as to why we even got started. So you could have a few investment goals, for example, retirement. And if you look at retirement, depending on our age, depending on perhaps how old we want to retire at. So there'll be a time horizon that we have in mind. So let's say 15 years. Some of us could be, looking at buying our first home, or maybe more homes. And of course, then there's also maybe a timeline linked to that goal. Here, I just highlighted the child's education investment goal because it's something that's relevant to me. I've also shared sometimes with some of the investors and readers about this part, this goal of mine. So, for example, I shared that I could be looking at a time horizon of 20 years if it's for my child's education. And I think the time horizon gives certain perspectives as to how much risk I can take. For example, if it's a longer time period, I'll be a lot more comfortable having more equities in my portfolio compared to bonds. And I think when it comes to investing, it's often a marathon, not a sprint. And I think it's important, therefore, to have this goal and this plan in mind always. Because otherwise, when we look at the markets like the previous slide, right, then we could be very emotionally affected by what has happened, in the markets, and then make decisions that could be a bit rash and not in line with the investment goals that we have. So just a little bit more on this portion on remember the why. For myself, I was talking about having a child's education plan. So what I have for one of my kids, it's a managed portfolio which is invested in both funds and ETFs. So just to run through a few of the points there in terms of how I looked at it. So firstly, time horizon of 20 years, because my youngest kid is 2 years old. So I think I would be comfortable, to have something in terms of the plan ready, let's say in about 20 years. I also want to have a globally diversified portfolio for him that can participate or invest in exciting long-term themes that will hopefully grow in importance in future. And thirdly, I need the discipline for this plan to stay on track. And one way to do that, and really the simplest way and the best way, it's really to have a regular savings plan. Because I don't want to be emotionally affected by what's happening in the markets, by what we read in the media, in the news headlines on a daily basis or every week, and then make a decision that's probably not rational. So with a time horizon of 20 years, I'm comfortable to have an asset allocation that has more in equities, roughly about 70%, with the remaining in bonds, which then would be about 30%. So the second part that I would like to share with you, which is really the focusing on the how part, which is the plan, building the investment plan, and which is essentially the topic for my presentation. So having the structure firstly and the discipline. So I'll run through some of these points in the subsequent slides. So I would just like to share firstly that when it comes to investment, for me, I actually look at all these various products myself. So I look at funds, I look at ETFs, I look at stocks. In terms of how I build my investment portfolio. So I have all of this. And the reason why I have these products, I think it's simply because they are simple products with a pretty transparent structure. I think it's fairly easy for most of us to be able to understand what these products are all about. And of course, for funds, they're not tradable on exchanges. For ETFs and stocks, they are tradable on exchanges. But of course, ETFs has some attributes of funds as well as some attributes of stocks as a result of all these features. So we'll talk a bit, of course, a lot more about ETFs today. And of course, there's a few points when it comes to ETFs that my colleagues will be talking about later tonight as well. So I won't really go into the details, but for example, EIPs and SIPs, whether they are excluded or specific investment products, I think in the Singapore context, that's a relevant point to take note of. Generally speaking, excluded investment products come with considerations that they are safer as opposed to SIPs. And of course, another attribute for ETFs, whether they're physical, which is invested in actual securities, actual stocks or bonds, or whether they're synthetic, which could be done via swaps, for example. And therefore, generally speaking, right, synthetic ETFs are considered a little bit riskier because there could be counterparty risk and so on. So my colleagues will be talking more about some of these features for you to take note of on the ETFs later on. So just to understand some of the ETFs better, I have a few examples here. So on our website, on fsm1.com or on our mobile app, FSM mobile app, you actually are able to see the top 25 holdings for all the ETFs that we carry. So on these couple of slides, I have the example of OGIC, which is one of the ETFs that we've been talking about for quite a bit in the last few months from our research team. So essentially, it's invested into the digital players of the world that have been benefiting largely from the changes brought about by COVID that I mentioned just now. So OGIC is, of course, the all-shares global internet giants ETF that's listed on the US exchange. And one of the reasons why we felt that this product could be interesting as a long-term addition in our portfolio is that this whole sector, the digital economy sector, is now worth 9.5 trillion US dollars. So if you look at some of our articles from our research teams, they've been saying that if you look at the digital economy sector, it's essentially the third largest sector in the world, or third largest economy in the world, behind just the US and China. It's larger than Japan's economy, it's larger than Germany's economy, for example. And I think if you look at the constituents on this slide, you'll probably appreciate as to why that's the case, because you're talking about Amazon, Alibaba, Tencent, all these companies that have done extremely well, this year because of their business model. And tonight we're having this webinar via Zoom, which is also in the top holdings for the OGIC, which is another point as to why Zoom has been doing well because of the changes brought about recently. The next slide essentially just wanted to share also some another ETF, which is the IXJ, which is a global healthcare ETF, which has also seen a sharp run up in recent months because of the concerns over COVID-19 and also of course over the benefits that some of these companies would gain from because of COVID. So these are some of the names that you're probably familiar with: Johnson & Johnson, Merck as well, Abbott Laboratories. So that's another ETF that incidentally I also have in my portfolio. I'll talk a bit more about that towards the end of my presentation. And another example, which is the Nikko Asian REITs, which is also in my portfolio. So you'll see some of the names here. So it's not just Singapore REITs that are inside, it's also some of the other ex-Singapore, other countries' REITs as well. But you'll see a lot of Singapore names here in the top 10 holdings. So just moving on into more details as to how we look at the construction of a portfolio, the investment plan that I was referring to. So I often use this example. So for those investors who have been looking at some of our recent webinars, we like to liken managing a portfolio to managing a football team. So covering the entire field, changing strategies, replacing players. So what do I mean by all these 3 points? So covering the entire field, it's ensuring that the whole pitch, the football pitch, it's well represented by the different sectors. So at the back with the goalkeeper and the defenders, it's always good to have something that's defensive that can act as a cushion in our portfolio, in terms of going through volatile periods of time. So generally speaking, of course, fixed income tends to be considered as a more stable asset class versus, of course, equities. So at the back, in the defense, you'll find, let's say, Asian bonds, you have global bonds, high yield bonds, but of course, as the goalkeeper, if you're a very Singapore-centric investor, then Singapore bonds would be the one that's cushioning the portfolio. Then as you move up into the midfield and into attack, midfield, you have your core equities, be it Asia ex-Japan, digital economy, and so on. And in as your strikers, right, those would be the players or products that are more tactical in nature. So in this instance, I gave the example of semiconductors and healthcare. So changing strategies, it's really applicable whenever we feel that there's big changes in the in the global economy structure and so on. So one of the things that our research team we've been talking a lot about in the last half a year or so, it's actually the changes brought about by the disruption in the global economy because of COVID-19, and we therefore talk about the inclusion of digital economy. So that's one example. And replacing players. So there could be, products that could be underperforming, and there could be newer products that are better, in the marketplace because, of lower tracking errors or lower fees and so on and so forth. So in terms of asset allocation, right? In terms of, if we look at the, let's say, the risk spectrum. So, we start from, let's say, the most conservative part all the way to the more aggressive part, and right in the middle we have balance, right? So what we have here, it's the neutral part at the top. So the neutral, it's always like irrespective of what's happening in the markets and our outlook on the markets. So if you look at balance, for example, 50% in equities, 50% for bonds as a neutral allocation. So at the start of this year, when we met investors at some of our events, so we were actually telling investors that we believe we should be overweight equities versus bonds. So at the start of this year, that's what we advocated. And I just mentioned on this slide that we did a recent change. We're still overweight equities versus bonds, but the change that we're basically telling investors this month, it's that we are reducing that overweight in equities. So we're reducing it by 2.5 percentage points. So we were essentially overweight by 7.5 percentage points in equities. So now we're reducing a little bit of that. So we're still overweight in equities, but just by 5 percentage points. So for example, if you look at the balance portfolio again, or the balance profile, so it's 55% therefore in equities and 45% in bonds. One thing you'll notice here is that the aggressive part doesn't change between neutral or equity or current allocation at this point. So for aggressive, we always feel that it's always good to have about 10% in bonds, no matter what our outlook on the markets, just to provide that cushion and buffer for our portfolios in terms of tackling the volatility in the markets. So just now, if you look, if I could maybe describe the previous slide as a more inter-asset allocation kind of slide. Inter because it's between two broad asset classes, which is equities firstly and bonds secondly. So here it's intra-asset allocation. So we go deeper within fixed income, and then secondly within equities, and we have all these various neutral weightages firstly, and also the latest weightages. So our research team have certain views on whether we should be overweight. For example, within fixed income, we're saying that we should be overweight Asian high yield. We've been quite happy to actually have overweight in Asian high yield because of the kind of yields we're looking at from Asian high yield products. We're also overweight Singapore-centric bonds, but we're underweight, the US high yield bonds within fixed income because of the run-up that we've seen as well. Within equities, where we generally feel that Asia ex Japan is very attractive, so we still are overweight there. We're also overweight China. China is also one example where we have moved China into a core portfolio. I'll talk about core and supplementary in a short while. And you'll notice, of course, digital economy that I've talked quite a bit about. We're neutral there. There's been a huge run-up in digital economy. So I think that's partly the reason why we're not saying we're overweight digital economy. So I mentioned about core and supplementary. So it's a very good concept, I feel, in terms of anchoring our tactical ideas, because especially in the last few months, the more tactical, the riskier ideas could be a lot more attractive for many of us because of that run up that we've seen, right, in some of the tech stocks, or even some of the healthcare stocks, or even in gold, for example. We can then be tempted to just jump on the bandwagon, and before we know it, the tactical ideas that we usually say you should keep in supplementary becomes a huge part of our portfolio. And while the good times would lead to a better return to our portfolio, but it also means higher risk. So we generally tell investors, always remember to keep the core part as let's say 80% within your equities portfolio. That should be core. And let's say 20% within your equities portfolio should be supplementary, which is essentially the numbers that I have on this slide. So, at the start, I was sharing with you that I'm comfortable for my, investment goal for my child education to have 70% in equities, 30% in fixed income. So within equities, therefore, if I do a simple 80% kind of call, then it's roughly about, let's say, 55%. And if it's 20% of equities in, then it leads to about 15% in supplementary as part of the total portfolio size. Another concept that we like to share with investors is a simple rebalancing exercise. And sometimes we get the question, how often should I rebalance? We often share, let's say once a year would be probably a good time. So once a year, what the rebalancing exercise does is to go back to the target allocation that we had at the start of the year. Because, during the year, various markets, various products could have performed better, some could have underperformed. And basically, it's taking profits from those that have performed better and then, using that and putting it into the underperforming sectors. So in this example, let's say Singapore has done well this year, then we would, sell a bit from the Singapore part and then put it back into the other underperforming parts like China. This is just a theoretical example. China has done pretty well this year. So it's just to go back to the target allocation. So once a year rebalancing, I think it's a pretty good benchmark in terms of, as a reference point. Also, timing is a risky affair, and it's something that we like to emphasize because, Peter Lynch, who is a famous fund manager, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. It's because we always try to think, hey, next month our market's going to go up, are they going to go down? And, some people have been a bit more worried recently because markets have run up so much, and they're like, there's going to be a correction. And, we could be a bit overwhelmed thinking of whether we should take profits and then, we should be selling out from equities entirely. So my point here is timing, it's a risky affair because there's no way that we can correctly predict how markets are going to move. And there's a lot of wisdom, I think, from this slide here, from this, from this image here, a lot of wisdom in saying that the timing the markets actually beats timing the market. So what essentially we're saying, looking at the results, let's say for these 5 indices, right, over a period of, let's say, roughly 30 years, if investors had missed the top, let's say, 30 best days in terms of returns in these markets, and if they had missed the top 20 days, as opposed to, let's say, staying fully invested, over a long period of time, definitely staying fully invested would have, delivered better returns. And I think another good example, the meltdown that we saw this year in March, and the eventual very, very quick super recovery in the market. So if, some of us had decided that, the meltdown in March, it's a sign that we should be selling out from equities, then that would have been actually detrimental to our portfolios. I talk a lot about RSP investing because I feel that it gives me the discipline to stay invested. And I think another quote here from Benjamin Graham, who is the, the father of value investing. So the chief problem for a lot of investors and his worst enemy is likely to be himself. So a lot of emotional, I think, distractions for a lot of us. And by having an RSP, it removes that emotional behavior and keeps, the guesswork out of investing. And of course, we enjoy the power of compounding, simply by investing every month. And also, of course, sometimes some of our investments could have dividends. So that adds to, the power of compounding effect. And, regular savings plan also, of course, the benefit is you can start from a very manageable initial investment amount. For ETFs, it's just $50 a month, for example, on FSM1. If you're looking at funds, then it's $100 onwards. On this slide, our research team churned out some numbers in terms of some of the crises in the past, right? And just comparing if, we had a regular savings plan as opposed to, not doing having a regular savings plan. I think basically just to summarize the slide, across all the crises in the past, whether it's from the Great Depression time all the way to the Great Financial Crisis, it essentially shows that with a regular savings plan, we would be able to recover our portfolio to the break-even point much, much faster as opposed to not having a regular savings plan. And I think that's another, reason why RSP is good. I mean, I probably don't want to go into the discussion as to, lump sum or RSP. I feel that both have merits. So usually how I personally look at it is I definitely would always want to have my regular savings plan in place. Lump sum, I think it works if I have spare cash. I mean, if, for those of you, if you're having a bonus, let's say at the start of each year, then that could be a lump sum that you could put it into the markets, into your portfolio. And when markets fall drastically, like let's say March, April this year, then that you could also then use a little bit of your extra spare cash to add to the markets. So that's how probably I will look at it, as opposed to, sometimes I hear investors asking me as well, so is lump sum better than RSP? So I feel that it's actually not so much about that, but it's more of a RSP, it's a must if you want to have a discipline, and lump sum, it's a good thing to add into the markets, when markets are down or if we have spare cash. So some of the ETFs that I have in my portfolio, so in terms of global equity, that's something that I've added recently. It's just a simple, I feel, a product that tracks, the global equities. And I thought it's an interesting addition to my portfolio. Typically, I don't have a global equity fund in my portfolio. I tend to like to zoom in into the individual sectors. But I thought for the ETF, in this case, I thought, at a really low cost, I can have access to a global equity ETF. I thought that was something that also is a good representation of how I want to have a globally diversified portfolio, in my portfolio. Digital economy, I talked about it. Indirectly, I have exposure to it via, a managed portfolio product. Healthcare, I also have that ETF as well as the Asian REITs. And the other ETFs that show up in the portfolio would be the Chinese technology that's done very well this year, and also the US semiconductors that have also done very well this year. So just wrapping up the last segment for myself. So I think some of the tools, I won't go into the details because, my colleagues, Catherine and Hui Shi, to some extent, will also be running through some of these features. So calculator, I like to share with investors as to why it's good, because when you have an investment plan, you also want to know potentially how this plan would grow and amount to. So we have this calculator on our website, and you can put a regular amount, let's say $500 every month, something that you're comfortable with in terms of investing every month. And if you have a lump sum investment already in place, so you can input that as well into the calculator. You can then look at different timing periods, different holding periods of 5 years, 10 years, all the way to 20 years. And then it will churn out basically the portfolio size eventually for you based on different scenarios, which is based on different rates of returns, annualized rates of returns. So I thought this is a useful reference point for a lot of our investors to look at. And of course, ETF Focus List itself, our research team just updated it in May this year. So you'll see the different sectors, core equity, fixed income, all the way to tactical plays. So just a simple classification here that I have. If you look at a core portfolio that I talked about, then essentially core equity, fixed income, regional equities would fit into your core part. And supplementary, then it will be more of your tactical ideas, your commodities, your single markets can feature in the supplementary part of the portfolio. And just to wrap up, our team has also recently, worked on improving our FSM mobile app. And it's an app that I've been using a lot more compared to the past. And the reason is simply because it's so much better than the previous version. So I actually found it pretty useful to, stay informed on my portfolio, how it's doing. And I would really encourage you as well, if you haven't done so yet, to download the app and just experience for yourself as to, whether the app is useful and whether you find that, keeping track of the markets and also keeping track of your investments is actually a lot easier. I certainly believe it has been for me. So we revamped this app in July, just recently last month. So feel free to download it if you haven't, and let us know how, your experience is on the app. So with this, I thank you for your attention, and I'll pass it on to Jonathan again.
Thank you, Jean-Paul. Now that you're more familiar with these investing concepts, we'll move on to our next topic. Exchange-traded funds are quickly gaining popularity amongst both institutional and retail investors, as they are a simple and cost-effective way to build a diversified portfolio. As its popularity increases, we want to ensure that investors understand what ETFs are, their benefits, and why they deserve a place in every portfolio. In this presentation, our equity analyst at iFAST Singapore, Hui Shi, will share with you what you need to know when deciding on an ETF. Hui Shi is an equity analyst with the research team at IFA Singapore, providing analysis and research coverage on both stocks and ETFs listed on the Singapore Exchange. Please help me welcome Hui Shi.
Hi everyone, this is Hui Shi from the Stocks and ETF research team. And so today I'll be sharing with you what ETFs are and why ETFs deserve a place in your portfolio. So here's an outline of my presentation today. First, I'd like to introduce you to ETFs, followed by the factors that you should consider before you select an ETF. And next, we'll move on to how you can construct a portfolio of ETFs. And last but not least, I would like to leave you with our ETF Focus List 2020. So let's first start with an introduction to ETFs. An ETF is also known as an exchange-traded fund. It's a basket of securities that tracks an underlying index. And so this provides investors to access to a portfolio of stocks, bonds, or even other asset classes. And an ETF works pretty much like both a stock and a fund. And the similarity between an ETF and a stock is that they are both tradable on exchanges during market hours. And the similarity between an ETF and a fund is that they both hold multiple securities, which forms a diversified portfolio. But unlike a fund which is actively managed, most ETFs are passively managed to produce a return that replicates its underlying index. And so an ETF will track an index like the market indices, STI, or even S&P 500, or even an index for a specific sector, such as the US tech sector. And one very popular ETF amongst the Singaporean investors is the Straits Times Index ETFs. So this STI ETF, they will track the performance of the top 30 companies listed on the SGX. And so by investing in this STI ETF, investors will be able to immediately get exposure to 30 different companies. And these companies include the Singapore banks like DBS, UOB, and OCBC. And so essentially, you do not have to invest in each individual security. You will just have to invest in one STI ETF in order to gain exposure to 30 different companies on SGX. And the STI ETF is just one example. There are many ETFs that can allow us to reach every corner of the market. So this table here will illustrate some of the common examples of ETFs. We have the equity ETFs, and this allows us to get exposure to the equity markets or to a specific sector. And we have a fixed income ETFs, and this allows us to gain exposure to the bond market. And if you're interested in commodities, there are ETFs that track the price of gold. And last but not least, we have the smart beta ETFs and the leverage and inverse ETFs. And I'll elaborate more about these two ETFs in my next slide. So what is a smart beta ETF? Firstly, smart beta uses a combination of both a passive and active management. And so a smart beta ETF will use a rules-based system to select stocks from a particular index. And the smart beta ETF will consider factors such as growth, earnings, or whether the stock pays dividends. And other than smart beta ETFs, we have the leverage ETFs. And leverage ETFs seek to amplify the daily returns of its underlying index. So for example, a leverage ETF can choose to amplify the daily returns of its index by 2 times or even 3 times. And last but not least, we have the inverse ETFs. And inverse ETFs aim to deliver a daily return that is based on the inverse performance of its underlying index. And so this graph on the right here will show you how leverage and inverse ETF actually works. So let us assume that the index is up by 1%, as denoted by this gray bar here. So if the index is up by 1%, the 2 times leverage ETF will amplify the daily returns of its underlying index by 2 times. And so the return for the 2 times leverage ETF will be 2%. And for the inverse ETF, if the index is up by 1%, the inverse ETF will deliver a return of negative 1%. And conversely, if the index is down by negative 1%, the 2 times leverage ETF will deliver a return of negative 2%, while the inverse ETF will deliver a return of 1%. And regardless of the type of ETFs, ETFs have been gaining popularity among investors. And the popularity of ETFs can be traced back to the 2008 recession. And since the 2008 recession, investors have begun to appreciate the advantages of investing in ETFs. And as more and more people are investing in ETFs, the ETF assets under management, which is the AUM, has reached a record of around 6 trillion US dollars as of end 2019. And this ETF AUM is still forecasted to continue to grow. And today, there are now more than 5,000 ETFs, and they cover most of the major indices in the world. And with so many people investing in ETFs, it is safe to say that investing in an ETF comes with various advantages. And the first advantage is that ETFs are low cost. The average expense ratio of an ETF is generally lower than active mutual funds. And assuming that all else is equal, having a lower cost will be able to give you a higher net return. And the second advantage will be diversification. A single ETF is made up of many individual securities. And so as compared to investing in a single stock, investors are less exposed to company-specific risks. And the third advantage will be accessibility. ETFs provide access to various markets and asset classes that may not be available to retail investors. And so, for example, corporate bonds, which are in sizes of 200,000 or more, are only available to accredited investors. But thanks to fixed income ETFs, even the retail investors are able to tap into this corporate bond market. And the fourth advantage will be that ETFs have flexibility. ETFs can be traded at any time on exchanges during the market hours, and this allows investors to quickly enter and exit their positions. And finally, the last advantage will be that ETFs have transparency. Since ETFs are listed on exchanges, investors will be able to know the exact price that they are buying or selling at. And also, ETF issuers will publish the holdings of their ETFs on a daily basis, and so investors will be able to know exactly which securities are in the ETF. And with so many ETFs listed in the market right now, for newer investors, it can be a little overwhelming when it comes to selecting an ETF for your portfolio. And actually, not all ETFs are made equal. And so here are some factors that you should consider before you select an ETF. And we have classified these factors into two different categories. We have the quantitative factors and we have the qualitative factors. So let's first start with the quantitative factors. The first quantitative factor will be tracking difference. And tracking difference is the difference between an ETF's performance and the performance of its underlying index. And there will always be a tracking difference between an ETF and its index. And this is due to many factors, such as expense ratio, rebalancing costs, currency hedging costs, so on and so forth. And if an ETF has a smaller tracking difference, this would mean that its performance is close to the performance of its underlying index. And so we prefer an ETF with a smaller tracking difference, since the main objective of ETFs is just to simply replicate the performance of its index. And the second quantitative factor will be expense ratio. An expense ratio is expressed as a percentage of an ETF's average net assets. Essentially, this is the cost that investors have to pay every year to cover for the ETF's operating expenses and management fees. And so this table on the right here will illustrate how the expense ratio can impact your returns. So let us assume that you put an initial investment of $10,000 in one ETF in the period of 5 years. And this ETF is able to generate a return of 10% every year. So if you invest in an ETF with expense ratio of 0.5%, at the end of 5 years, your investment will be worth $15,742. And this is after $363 has been subtracted off due to the expense ratio. And so the expense ratio's impact on your returns will be negative 2.25%. However, if you invest in an ETF with a higher expense ratio, say 1%, at the end of 5 years, your investment will be worth $15,386, which is slightly lower. And so the the expense ratio's impact on your returns will be negative 4.46%. And so what this table is trying to tell you is that the higher the expense ratio of an ETF, the greater the impact on your returns over the long term. And you may also notice that even a small difference in expense ratio, like 0.5%, can have a significant impact on your returns. And this is why we prefer an ETF with a lower expense ratio, as the lower the cost, assuming that everything else is equal, the higher your net returns. And the third quantitative factor will be liquidity. And liquidity refers to how easy it is to buy or sell an ETF quickly without affecting its price. And unlike stocks, ETFs have two layers of liquidity, namely the primary and the secondary liquidity. And the primary liquidity is determined by the liquidity of an ETF's underlying securities. But for retail investors like us, we are more concerned about the secondary liquidity, which is determined by the volume of actual ETF shares traded. And this is also referred to as the on-screen liquidity, as it is the liquidity that investors are able to see on your screens. So it will be your things like the trading volume and the bid-ask spread. And we prefer an ETF with a higher level of liquidity, so the ETF should have a higher average daily volume and a smaller bid-ask spread. I've now covered the quantitative factors, so now let's move on to the qualitative factors. And the first qualitative factor will be the choice of index. This may seem very obvious, but it is important for investors to understand the index that the ETF is tracking. And the index has to be a good representation of the market and the sector that the ETF is supposed to be tracking. And knowing the top 10 holdings of an ETF is useful, as it will be a good gauge of the ETF's underlying exposure. And on our FSM website, you are able to see on the ETF fact sheets, you can see the ETF's investment objective and also the ETF's top 25 holdings. And the second qualitative factor will be the structure of the ETF. Investors should be able to know and understand the structure of ETFs. And there are two different kinds of ETFs. We have the physical ETFs and we have the synthetic ETFs. And for physical ETFs, they hold the actual underlying securities that make up the index. And if the ETF holds all the underlying securities, we will call this a full replication. And if the ETF holds only a sample of the index, we will call this a partial replication. And a physical ETF usually uses full replication. And partial replication is usually used when there are liquidity issues or when there are too many holdings in the index. So it will not be realistic for the ETF manager to buy up all the securities just to replicate the index. And other than physical ETFs, we have the synthetic ETFs. And synthetic ETFs rely on derivatives to execute its investment strategy. And this allows investors to invest in markets that are illiquid or hard to access. So for example, most oil ETFs are synthetic ETFs. And for a synthetic oil ETF, instead of holding actual barrels of oil, which can incur transportation and storage costs, a synthetic oil ETF will be holding oil future contracts, which will track the movement of crude oil price. And one very important point for investors to note is that since synthetic ETFs uses derivatives, investors will be exposed to counterparty risk. And so here's a summary of all the factors that we look at when we select an ETF. We have the quantitative factors and we have the qualitative factors. So under the quantitative factors, we look at the tracking difference, expense ratio, and liquidity. And under the qualitative factors, we look at the choice of index and the structure of the ETF. And now that we've established how we can select an ETF, I'll be sharing with you how you can construct a portfolio of ETFs. And so for a start, depending on your risk profile, you can determine an inter-asset allocation for your portfolio. So if you are using a balanced strategy, you will be 50% of your investments in equities and 50% in bonds. And if you are using an aggressive strategy, it will be a 90% of your investments in equities and a 10% in bonds. And to construct a portfolio of ETFs, we use this method called the core supplementary portfolio approach. And under this approach, we will separate our ETF investments into two different sub-portfolios. One is called the core portfolio, and the other one is called the supplementary portfolio. And under the core portfolio, it will consist of your long-term investments, and this will set the foundation of your entire portfolio. And for this portfolio, we recommend that 80% of your total equity allocation should be invested in ETFs that track the broad markets like US, Europe, and Asia ex-Japan. And we believe that this will provide investors with a diversified exposure to the global markets. And also not forgetting that fixed income ETFs should be part of your core portfolio. And fixed income ETFs are able to generate stable cash flows, and they can serve as a cushion when the markets are not doing well. And next, we have our supplementary portfolio. And this portfolio will consist of your tactical allocations to specific sectors. And since the investments in this portfolio may potentially carry higher risk, this has to be closely monitored for changes. And we recommend that this is kept at 20% of your total equity allocation so as to prevent the overall portfolio from becoming overly aggressive. So here's a sample of a core supplementary portfolio. Under your core portfolio, you will have the ETFs that track the broad markets like US, Europe, Asia, and emerging markets. And fixed income ETFs should also be part of your core portfolio. And for an aggressive strategy, it should be around 10% of your entire portfolio. And under our supplementary portfolio, we will have the ETFs that track specific sectors. It can be sectors like the US semiconductor industry, the China tech sector, or even the Chinese banks. And we recommend that this is kept at 20% of your total equity allocation. And before I end my presentation, I would like to share with you our ETF Focus List 2020. If you're looking for an ETF to include into your portfolio, you can check out this ETF Focus List. And you can find this focus list on our FSM1 website and under the ETFs or the Research tab, and click on ETF Focus List. And this ETF Focus List is curated by our research team, and it features ETFs across 6 categories. So there will be the core equity, fixed income, regional equity, and a single market equity, which will form your core portfolio. And the remaining 2, commodity and the tactical plays, will form your supplementary portfolio. And the selection methodology for this ETF focus list is based on both quantitative and qualitative factors, which I've just shared about earlier in my presentation. And so investors can utilize this list as a source of idea generation for ETFs or to even construct a portfolio of ETFs. And that will be the end of my presentation. And I hope that this was useful to you. Thank you, and I'll pass the time back to John.
Right. Thank you, Hui Shi. And I hope that all of you have gotten a better idea of what to look out for whenever you're trying to decide on an ETF. So we'll now move on to our final speaking segment for today, where we'll show you some of the practical steps you need to take in order to invest in ETFs on FSM1.com. We'll also introduce you to some tools which are available for free that can help you to hone in on your first ETF. So taking us through will be Catherine Chua, who is our investment advisor at FSM1.com Singapore. As an investment advisor, she provides clients with sound investment advice, as well as ways to construct a portfolio that can meet their financial goals from the numerous investment options available to them. So over to Catherine.
Okay, hi. Good evening, everyone. My name is Catherine. I'm an investment advisor with FSM1. So today I'm just going to share with you some of the practical tools that you can actually use our website for to explore and also go about selecting your very first ETF. So we do have many useful tools on our platform available, and I'll walk you through some of them. So ETFs are actually listed on various exchanges. So using our platform, you can get access to these ETFs traded on US, Hong Kong, as well as Singapore exchange. So our ETF fees are very low. It starts from 0.08% per trade, and the minimum investment is $10 Sing, or US dollar 880, or Hong Kong dollars 50. So since start of the year, we have witnessed unprecedented economic events and as well as market volatility. So rather than to catch the bottom of the market and try to time, we have always recommended our investors here to adopt a dollar cost averaging strategy. So I would say this is the time where you start a regular savings plan and invest a fixed sum regularly, rain or shine, into the markets. So this take away the fear of investing at the top because you will be able to average down your investment costs. And so on our platform, we have enabled a selected list of ETF that allow you to do this RSP, and it's very, very affordable. It starts from just $1 for the subscription fee, and the minimum investment starts from $50 a month. So I'll touch on more on this RSP scheme later. And also, ever since we launched our stockbroking services in 2017, there have been many, many requests in the community to allow us, ask us to use our OA as well as SRS investments for stocks or ETF purchases. So just earlier last month, we have introduced this facility to allow clients to invest using their CPF OA as well as SRS in selected stocks and ETF that's listed on the platform, also at the same affordable fee of 0.08%. Yeah. So we do have this tool called the ETF selector. So basically, you just need to log into, you don't even need to log in at all. You just go to our website. Under the ETF tab, you select this ETF selector. And further down, you can actually choose this based on your investment criteria or based on your parameters, be it like US sector, or in fact like payment methods such as SRS, OA, or in fact a trading currency, like perhaps you only hold US dollars and you want to deploy some of these US dollars. And you can also select categories like equity, commodities, or money market, bonds, etc. So after you have populated the list, you will see a whole list of ETF, and you will be able to click into every single one of them to find out more of the information on the landing page itself. So on this landing page, it might look a bit intimidating because there might be a lot of information, but not to worry, I will guide you through. So first and foremost, when you come to the landing page, it will show you like what is the previous close price of the ETF and the name of the ETF, as well as some actionable buttons that you can click on, such as adding it to your watch list, or even set a price alert or straight away start trading. And also on this page of the ETF, you will be able to spot like what is the fund size and what is the 52 weeks range. Are you at one of the most expensive point in time to actually invest, etc. Yeah. So further down, you can actually make use of these investment icons such as ETF info, investment info, or even the TA chart to look at the price history and all for the ETF. And yeah. Okay, so if you scroll down further, right, on this investment info tab, you do see this thing called the expense ratio as well as the historical dividend. So these are one of the top few questions that we always get from our investors, like whether that particular ETF that we have mentioned, do they pay dividends? And also if they do, how frequent do they pay? And itself, we also do link the website to the ETF provider. So like iShares, Vanguard, you can go onto their website to find even more information of that. And on this page, we do tell you what is the trading currency as well as the bought lot size. So example, like what is the minimum investment that I can actually buy into this ETF. So different markets do have different bought lot size. So you just do have to take note of that. And if you scroll down further, it will bring you to our top 25 holdings, which just now which has shared. So you'll be able to see like the weightage of each of the ETF, like how much is it allocated in which stocks, and also just a quick reference, like maybe to check whether or not this is the right ETF for you, or how has the ETF stock pick like. You can look at the year-to-date returns. We will be written on this column, and you can just click next to see all the top few holdings of this ETF. So earlier on those actionable buttons that you have clicked on, which is like the ETF watch list or even like the price alert, you can use our mobile app and click on this watch list icon. It will bring you to all the stocks or even counters of ETF, bonds, unit trust investment, everything that you want to have a look at, the latest price, bidders, volume, it will all be in this ETF, and you can easily edit them to change or to rename, etc. And this part would be like the price alert. So you can actually set like a floor or a ceiling price to the ETF, and we will actually notify you via an in-app notification, and you can straight away add a new alert just using this icon. So for more info, you can just go to your App Store or even your Play Store, just find FSM mobile app. So the next step, right, before you invest, you of course want to know like what is the detailed breakdown of the fees. Are there any other hidden costs, etc.? So for all our ETF, there is no platform fees. You just have to click on this ETF calculator. You will be able to see what is the buy and the sell, the processing fee or the exchange fees. So first and foremost, it's very, very intuitive. You just need to select from the drop-down list. Just select whichever ETF that you plan to invest in. Click on the side, is it buy side or sell side? And then click on the lot size as well as the price. And then this right-hand column, it will be populated, the breakdown of the fees. So our analysts do publish very regularly on their key investment ideas and their takes on the latest economic trend and outlook. So for more investment ideas, you can just click on this ETF ideas over here once you are on our website. And also, if you are free tomorrow and on Friday, you do feel free to join us at around this time as well to hear more insights on our analysts' insights on these mega trends. Yeah, and you can also join us on Saturday morning at 10 a.m. for the Q&A to find out more of the panel discussion. So here are some of the sectors that we have gone through previously and we have mentioned are like the digital economy space, Asian REIT, semiconductors, banks, cloud computing, etc. You'll find a lot more investment ideas just by going to our website and click on this ETF ideas here. So moving on, just now my colleague Hui Shi, she have mentioned about the ETF focus list. So basically, just a quick recap, these are the ETF lists that have curated for new investors like you who maybe you have no clue on what to invest. I would do think that we do give a very a quick overview of all the starting points of all the ETF that you can actually consider for each individual major equity markets as well as the fixed income markets across the globe. So it is not a be-all and end-all list for everyone's portfolio, but it's really a very, very good starting point if you don't know what to invest in at this point. So they are all selected via qualitative and quantitative factors, which Rich has mentioned earlier. So I'm not going to dive more into that. So moving on, we have talked about the RSP, regular savings plan for the ETF. So it is a very cheap way to get exposure to a specific country or even a sector. I mean, it's a type of index tracking performance if you invest via ETF. So using an RSP, as low as just $50 a month, you'll be able to get exposure to all these indices, and you can even have a very niche exposure like Asian REITs, Chinese tech, US banks, etc. So the fees are also very affordable at just $1. Yeah. So moving on, once you have invested, the next thing you want to know is how to monitor. So on our website, it's really not very complicated. You just need to go to live trading under portfolio. You will see all your investment holdings as well as the P&L written and also calculated properly for you like in its stocks currency. So at any point in time, if you want to buy or sell, you can just hit the actionable buttons. Yeah. So after hearing how to navigate and how to actually build your portfolio, this is the key part to actually get started. So to complete, I mean, just to start investing, there's this thing called the customer account review. We call it CAR for short, that you have to actually do. This is the MAS requirement because ETF are considered a specific investment products, which is called SIP. So you do have to pass this before you can invest in. So in order to pass this, it's very easy. You just go to reassess CAR tab. For this step, you must have an account here before you can proceed on. Yeah, so even if you do not pass, there's this box that we will actually prompt you to take to activate your investment products so that you can start transacting in this ETF. Yeah, so the second step is to fund your account with money. So our stocks tradings are based on a pre-funded basis. So you do have to do a fast transfer or a pay now to your investment account before you can start trading. Yeah. And also, if your ETF that you selected happens to be traded in US dollar or Hong Kong dollars, you will need to do a currency conversion of these funds to convert your Sing dollar to those trading currency. So you can just do it on here under the foreign currency exchange. This is 24 hours, 24/7. You can do it any time of the day. If you don't like the rates, you can revisit again a couple of hours later. It will just keep changing. Yeah, so now it's the real deal. We have to go to the live trading tab and to execute your desired ETF or ETF choice. So you can just either input the stock code or if not the name of the ETF. So it's just 3 quick buttons under live trading, quick trade, and then your stock code, ETF code. Yeah. And also for applying RSP is something for longer term investment. That means rain or shine, you just invest religiously. So all you need to do is to just log into your account and then click on apply from the RSP tab. So in this tab, you will be able to view all the 49 ETFs that we have available on the list, and we'll show you what is the minimum investment amount. So for all ETF except for the gold, the minimum investment amount is just Sing dollar $50 or equivalent in this trading currency. So for instance, if I picked out something like say S&P 500 ETF going by the stock code IDV, I can just key in like maybe my monthly investment amount of $100, and I just click on the proceed to checkout button, and that will be all. Yeah, and to complete this entire process, because it's a regular savings plan, you do have to remember to fill up, to key in your gyro details. So we will take money automatically from your desired bank account, and you'll be top up into its respective currency. So for earlier, like example, if I chose a US dollar ETF, the money from my gyro will automatically be funded into this US dollar cash account to buy into the ETF on the 8th of every month. Yeah. So I've come to the end of my presentation today. So I do hope like all these tips and tools have helped you in some step of your way of investing. And I will pass the time now to Jonathan. Yeah.
Of our speakers this evening, and also thank you especially to all of you who have stayed with us for the past hour and a half. We hope it has been a helpful session for you. So just a reminder that we have 3 more days of this excellent content prepared for you. So there will be another session just like this tomorrow evening, Friday evening, as well as Saturday morning at 10 a.m. Head over to etffestival.fsm1.com to register for these webinars. So that is all for tonight, and we hope to see you in the next few days. Take care, stay safe, and thank you all.